This is Jay Martin.
Sam, thanks so much for joining me today. I'm excited to chat with you.
Thanks very much for having me on, Jay. I appreciate it.
My pleasure. Now, why don't we get started by speaking a little bit about your portfolio? I'm curious, before we get into this, just for context, where you have your wealth stored right now. What does your portfolio look like, Sam?
I mean, personally, most of it is in equities, mostly mutual funds, index funds for the most part. Because of the type of work I do, writing research for institutional investors, I have to be careful about my own personal holding and personal trading to make sure there's no conflicts of interest, particularly as an independent, research provider. I want to make sure that the clients know that I'm not doing anything, kind of front running and all those kind of things when I write research about certain stocks or assets. But for the most part, it's in diversified mutual funds, mostly U.S. and global equities.
U.S. and global equities. Now, the clients that you advise, right, mainly institutional investors, talk to me a little bit about where you're seeing trends in capital allocation on that front. Where is money going right now?
Well, certainly lately, a lot of it has been going into your cash, defensive holdings. People looking for something to protect them from volatility, and that volatility is coming across all assets, including bonds, long-term bonds, which are often considered kind of the safe asset, have not been at all this year. Currencies have been volatile, commodities have been volatile. There's really been almost no place for an institutional investor, even with a broad remit, to hide this year. So, cash has become popular, particularly as interest rates, here in the U.S. have risen. So I think there's a lot of defensiveness out there right now. People kind of making smaller bets, trying to protect what they have and not go out on too far out on a limb just yet, waiting for things to stabilize is kind of the message I've been getting from a lot of people.
And are you, this might be a silly question, but are you surprised at all that the US dollar still holds up as well as it does as that ultimate safe haven asset class? And the reason I ask this is because a lot of my content focuses on the precious metal space. And within that industry, there's a lot of critics of the US dollar and the vulnerability of it and all of this. And I always listen to that and I say, okay, great. Yeah, there's a lot of problems with the US dollar, but relative to every other currency, there's no question about where you want to be, right? And I get a lot of pushback on that. But, I would look right now, like people have voted, right? US dollar's up. It's the only index that looks great right now. And so do you ever get pushback from your clients when you are recommending maybe the dollar trade, or talk to me about that?
Yeah, no, you're right. I hear a lot of the same things sometimes about the dollar, kind of from a structural standpoint, and then also sometimes from just more of a tactical trading standpoint. And I think you're right. I mean, saying whatever might be wrong with the dollar or the U.S. economy, everywhere else is worse. There is no real alternative in terms of a currency that would be safer or more liquid or something like that in the world right now. The euro is probably the closest competitor, but it's been very weak, and it is just it doesn't have the same some of the same benefits, and certainly not the history that the U.S. dollar does. So anytime someone says they don't like the dollar, I always ask them, well, okay, what do you prefer? What are you going to go into? And they might say sometimes they'd go into the Swiss franc or or the yen or some another kind of considered safe currency, but that's usually more on a tactical basis rather than a long-term structural thing, because those currencies simply aren't big enough to handle all the money that's currently in the U.S. dollar in some sense. So I think from a structural standpoint, it's going to be hard to knock the dollar off of its perch in terms of just the place people want to go. Now, right now, of course, higher interest rates in the U.S. will naturally tend to bring money into the U.S. Relative to, say, Europe or Japan, Switzerland, places like that, where interest rates are still quite low. So there is, an obvious reason to hold more dollars now, just because you get paid more to hold dollars. But I think in terms of general stability, liquidity, it's hard to find an alternative to the dollar. And so I think that's going to be like that for a while longer. Yeah.
Hold up, quick interruption to shout out one of our partners here at the Jay Martin Show. This is Masterworks. Now, Masterworks is a platform that gives retail investors like you or I the opportunity to fractionally own pieces of blue chip art. So we're talking about Picasso, Monet, Banksy, etc. Now, why is this exciting? Because the smartest money that I have on my show invests in the art sector. So I want to do that too. Now, last year, I actually bought 2 pieces of art for my home. But knowing nothing about the art industry, I have no idea how they're actually going to appreciate over time. Now, I like them, and maybe that's enough. But if I want to put my cash to work in the art sector, I really want to go after the biggest names in the business, the multi-million-dollar pieces. And this is the access that Masterworks gets you. So check out masterworks.io now. Yeah, I would speculate my lifetime. Now, if, but this dollar rally we're seeing right now probably will roll over, right, in the maybe near to medium term. And my question therefore is, where's that cash going to go to next, right? Where does the puck go next? And do you want to speculate on that for me, Sam? Do you have any thoughts?
Yeah, I think you're right in the sense that the dollar's had a really big move. There's a lot of bullishness on the dollar right now, more so than for a number of years. My guess, if I had to guess, would be that if things get better in the world generally, in terms of global economic growth, COVID, the war in Ukraine, things like that, then I think actually Europe, the euro might see some of the money go back there that's come out of the euro recently, where it's been so weak. I think that's kind of the potential. I guess right now it'd be a contrarian trade in the sense that that you'd be going against the trend recently. But I think that Europe has some potential to recover if things get a bit better globally. If things don't get better, then I think a safe haven currency like the yen or the franc are going to be where people rush to if they don't like the dollar as much. So I think it's a question of if you're willing to take a bit of risk, if things are looking a little bit better globally, a currency like the euro would look good, or the pound. But if not, then you're going to stick to safe haven currencies.
Right. Now, what are you most concerned about at this moment, Sam, when you look at the global economy? I mean, you're in the business of providing research to those who are allocating capital. Are there any headlines that are most concerning to you?
I think the big, one of the big risks right now is that the Fed and the central banks in general will go too far. They'll over tighten. They'll be looking at the lagging kind of CPI inflation data, and they'll keep raising rates even while the economy is clearly slowing down. And I think we're kind of near that point. We're getting closer to that point now. I think we haven't over tightened yet, and we could probably withstand, somewhat more higher rates from here. But I think that the risk there is that policy over tightens. Because we've already seen, in my view, fiscal policy in the U.S. certainly has tightened a lot from where it was, a year or two ago. We had, historic stimulus for a while, and now it's gone very, very dramatically the other direction, and is actually starting to go from sort of what I would think of as more of a neutral kind of stimulative effect to almost contractionary, as tax receipts are going up and fiscal spending is going down in the U.S. So I think that is putting the brakes on things, along with the Fed raising rates, and those two things combined are going to run the risk of overdoing it in a bid to sort of break inflation, which I think will probably come down by itself naturally, over the next 6 to 12 months. Okay. Now, that's a risk that's being driven by the big picture risks of COVID, still mostly in China, and of course Ukraine. And so those supply related issues are really the ongoing risks, and how countries and everyone else manages them is the bigger risk. And those have certainly been things that have kind of piled on essentially. We had the initial wave of COVID. Now in the Western countries, it's gotten a lot better, but China's really struggling with it now still. And then you had Ukraine come along on top of all that and restrict energy and food supplies in Europe. And so that's kind of been a big 1-2 punch on supply. I think that's really getting over that's going to take a while. I think people have taken steps towards that, but I think it's going to be the big risk going forward is how that's managed.
Interesting. Now, I've heard that theme a handful of times, that one of the biggest risks we're facing right now is that the Fed over tightens, takes this policy too far. Maybe the inflation expectations become a bit too excited. And like you said, this may come down in 6 to 12 months. Maybe we're seeing peak inflation already. We don't know. We'll have to wait and see. So run this forward for me. What's the consequence of the Fed over tightening? How does that affect and impact the real economy and the market?
Well, I think to some degree, what the Fed mostly has influence over, of course, are the interest sensitive parts of the economy, which is housing, autos, and other sort of things where people have to borrow a lot of money. And we're already seeing the housing market kind of slow down pretty rapidly. And we're seeing that in some of the macro data with home sale data, and mortgage applications have plunged to almost nothing now. People aren't used to seeing a 5.5–6% mortgage rate in the U.S. It's been many, many years since anyone's seen that. And so between that and the home price appreciation that's already happened, just housing affordability is back to 2006, 2007 levels. So that's really already had a big impact. And the Fed isn't even done raising rates yet, because of course the market anticipated a lot of this, and mortgage rates have already gone up much more than what the Fed has done in anticipation. So I think if the Fed keeps pushing and keeps pushing, you're going to get not only an inverted yield curve, which tends to be bad for the financial system, you're going to get housing really cracking under pressure, and then you'll follow along with autos and everything else that's interest sensitive will start to break down because people just can't afford it anymore. And so I think that's the risk, is that the economy is already slowing down to a point where normally inflation would slow. Look at leading indicators. You look at kind of the current GDP growth, things like that. Those are already at levels that would say, okay, we're at moderate growth and slowing, so you probably shouldn't need to tighten anymore. But if you look at CPI data, you'd say, oh no, we've got to go much higher on interest rates. And the Fed is under a lot of political pressure, public pressure to do something about it. And I think that's the risk, is that they push that too far to make it look like they're doing something, rather than responding to the data that they can see it too. But it's a question of almost being peer pressured into raising rates further than they really think they should.
Right. And an impact of that I'm seeing locally anyways, is that as rates go up, fewer people are applying for mortgages. You said it, that's increasing the population of renters. And our rental market now is crazy hot, right? If the housing market's cooled off, rents are hitting all-time highs. And my little town and down in Vancouver, only half an hour away. And, when I think about that, I wonder how that plays out, right? Does that play out in favor of those who own the assets? They increase their yield on those assets. Simultaneously, housing prices come down and they're more able to leverage into new acquisitions. Do you have any thoughts on how that scenario unfolds and plays out?
Yeah, there's definitely been a big increase in, people buying residential real estate in order to rent it, from, kind of the Blackstones and so forth all the way down, as a business model that wasn't nearly as big, in past years. And some of that is just kind of the natural search for yield, for real assets, besides, stocks and bonds, financial assets, and to take advantage of the kind of, what people think might be a structural demand for housing and lack of supply. But I think what the risk there is that that's all very finance sensitive, meaning if the cost of money goes up too far, all that becomes unprofitable at some point. And then you see all those buyers that have been in the market now, retreat, and you start to have, a pullback. Now, what is better this time is that the banking system and the mortgages and things are not nearly as risky as they were, say, in 2006, 2007, when we had the real housing crisis. Banks have been much more conservative about who they lend to and how much they've lent in the last few years. It's been more to high credit score borrowers and things like that. So I don't think the banking system as a whole is going to feel the same type of pressure, although it will become less profitable because of fewer mortgages and more write-offs. It won't come under the same pressure as it did, whatever it was, 14, 15 years ago. And I think that's the good side in some sense, but I think there is some downside to housing prices potentially, and to the people who have leveraged themselves into that market. Whether it be private investors or publicly traded firms or whatever. So I think that's the risk there, is that all that money that's come in starts to come out again, and that there's dislocations as a result. Right.
Okay. So we talked a little bit about, I would call it like the defensive strategy, which is the flight to dollars, right? And we're seeing that's definitely consensus. Are you recommending any of your clients start playing offense anywhere? Like, are you getting aggressive anywhere? Are equities at a level where you're excited about getting into that market? Talk to me about that. Where's the offensive play?
Yeah, it's been tough lately because we've had so many sort of mixed signals and unusual historical situations, where normally you'd say, all right, you should buy low beta stocks, defensive stock, which is what a lot of people have been doing. except for the fact that, say, energy stocks have been some of the best performers this year, although not just lately, and they're high beta stocks. And so you've had a sort of a strange disconnect where some of the riskiest stocks in terms of their volatility, the sort of risk profile, have actually been the best performers, even though the market as a whole has been down, and therefore would normally favor the low risk stocks, the consumer staples and utilities and so forth.
Yeah.
Now we have been starting to see, some of that, change a little bit lately. Energy stocks have come down a bit, and there's been a little bit of a balance in some of the growth stock, technology, and so forth recently. So if I was going to look for something more sort of offense related, I would probably look more towards the like technology and growth stocks that have been beaten down badly this year and that had gotten very overvalued, towards the end of last year, as a place to go as growth in the overall U.S. and global economy starts to slow again. Rates are higher, things are slowing down. I think the premium for a growth stock may start to come back, not right away, but over the coming months. So in terms of a rotation from the kind of value commodity-oriented stocks have done very, very well the last, say, 12 months. I think you might see a rotation back towards the tech stocks that have been beaten up pretty badly lately. But some of them, of course, will go away. But some of the ones that hang around that have real earnings and so forth will probably be the ones to look for if you're looking for offense over the next, say, 6 to 12 months.
Okay. Do you encourage your clients to have an allocation to gold?
Not as a sort of a structural matter. There are times when commodities and gold in particular, will start to look attractive. But I think, I have a hard time analyzing gold, at least from an asset allocation standpoint, in terms of, saying, what the real fundamental drivers are beyond just sort of risk sentiment in general. It's sort of, it's hard to, you certainly can't analyze it from the standpoint of, earnings and cash flows. And it doesn't always behave as you would expect when it's, risk on, risk off, that there's been a risk off market, but gold, hasn't done very well lately. So I think it's, it's a tough one, for me to make strong recommendations for. And some of my clients, have mandates that would allow them to buy it anyway, at least directly. They can own gold miners, for instance, the companies, but they're, some of them can't own physical commodities. So it's partly a matter of what the clients, are focused on or what their mandates are. And part of it is, it's hard to draw a straight line between a lot of the indicators that I watch and what gold prices do. So I'm much more comfortable with equities, debt, currencies, that kind of thing, where it's a little bit more of a direct relationship with the fundamentals.
Makes sense. Okay. So if a client came to you today, Sam, and said, I have $1 million. Sam, your only goal is to protect the purchasing power of this $1 million. Time horizon is short. It's only 5 years, right? Where do you go with that $1 million? Where do you put it?
I mean, if you really are only worried about protecting purchasing power, then you have to look at TIPS. They're not the Treasury, inflation protection securities. They're not especially attractive, but they do at least have a positive yield now, which they hadn't had for several years. So I think if you really are only focused on purchasing power protection rather than any kind of growth, then you'd want a pretty hefty allocation to TIPS. Now, I would keep some allocation probably to low volatility equities. So like a low volatility fund that would have a decent dividend yield and stable growth over time with moderate volatility, kind of a mix of TIPS and low vol equities would probably be the best way to do that.
Same client then comes to you and says, okay, Sam, I also have 100 grand here. I don't care if I lose it. I want your wildest speculation idea. Same time horizon, 5 years. Where would you look to? High risk, exciting upside. What catches your attention?
I mean, I think, like I say, I think some of the the small cap growth tech stocks that have been beaten down the most, if you were careful about it, you could probably pick some of those that would do well. And like I say, it's to some degree European stocks, which a lot of people are very negative on right now. Those would be some of the places I would look for, kind of higher risk areas that might do well, say over that time horizon. You have to be slightly careful about it, but I think those are areas that, because they are beaten up and gotten much cheaper now, would be a place to put some more of the more speculative money. I don't really pick individual names so much. I have a sort of quantitative process that can do that for clients, but I think the small cap growth stocks that have really gotten beaten up badly, if the pressure from interest rates and things like that kind of is reduced, I think there's going to be potentially some rotation in some of the stronger areas there. Yeah.
Yeah. Okay. I love that. Look, Sam, thanks so much for coming on today. I want to point people to where they can find you. More about the firm, more about yourself. Where should we send them?
Oh, so millstreetresearch.com has got all the background on my work. It's got some sample reports. I have a blog there that I update about once a week that'll just talk about macro topics and show some of the indicators and things that I look at. I'm also Mill Street Research is on Twitter. You can find me there. So I'm posting most days some brief comments on what I see in the macro world. So I would say for those who want to get a feel for what I'm doing, also on LinkedIn, you can find me there on Mill Street Research. So the website or social media are good places to follow. And otherwise, you can certainly reach out. info@millstreetresearch.com is the email address. You can find me there as well.
Okay, awesome. Once again, I appreciate it, Sam. Thanks so much.
No, my pleasure.
All right, thank you for watching this interview. Now, 3 things before I let you go. Number 1, I publish a weekly newsletter and I love writing it. I share my biggest takeaways and action items from the conversations that I have on this channel. In addition, my thoughts on current events, economic events, political events, and you can subscribe for free. Just hit the pinned comment right beneath this video, or just go to jmartin.club and you can subscribe on the website. I'd love to have you join the team. Number 2, ad revenue from this channel is donated to an organization that is super close to my heart called Zero Ceiling. Now, Zero Ceiling's mission is to end youth homelessness, and the way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas and then provide them with supportive housing, career training, and just generally positive influences on their life. I love what they do. Check them out if you're interested. And number 3, if you prefer to listen to my content as opposed to watch it, you can find me wherever you listen to your podcasts. Just search for The Jay Martin Show. All right, thanks again.